Okay, it's 1 o'clock. So I'm going to go where I think we left off last time. And that is I know we looked at this slide. I think we looked at this one. And I think we looked at that one. I don't remember talking about the Pell Grants. So the federal Pell Grant program assists students from lower income families who are attending college. Public institutions treat the Pell receipts as non-exchange revenue upon receipt of the funds. Non-operating revenue is increased upon receipt of the Pell Grant. Student financial aid, a contra revenue account is recorded in the same amount. Private institutions treat these as resources held for the student in an agency relationship. So in other words, the money doesn't actually, if Belhaven gets a Pell Grant for a student's tuition, Belhaven doesn't consider it that they actually own the money. It is being used on behalf of the student. So it's like an agency relationship where you're taking care of what belongs to someone else and then applying it to the tuition. Something that you might think is interesting about Belhaven. Belhaven is rated as one of the universities in the country with the highest rate of, and I'm trying to remember exactly how they worded it. It was something like social or economic improvement. That is, having low income students come as students and then get good jobs afterwards and getting out of the poverty or whatever because they now have a college education. And Belhaven got distinctive recognition for being unusually effective at doing that. So differences between public and private. First was how they treat the Pell Grants. Second is reclassification of net assets with donor restrictions. FASB standards recognize contributions with donor restrictions restricted upon receipt of an unconditional pledge. Since under FASB guidelines, all expenses are recognized as without donor restrictions, a reclassification from with donor restrictions to without donor restrictions is necessary once qualifying expenditures have been made. In other words, if they received a donation that's restricted, they can't record it as an expense until they've used the money the way that the donor intended. And this reclassification doesn't exist for public universities. Third difference, time restrictions. Time restrictions are viewed as an eligibility requirement under GASB standards, and time-restricted contributions are not recognized as revenue until the time period is commenced. Since many pledges of support entail implied time restrictions, public universities are less likely to recognize pledged donations until received, even if there's no restriction on the use of the funds. For similar reason, pledges for endowments are not recognized as revenue by public institutions until received. Fourth difference, GASB has no provision for recognizing contributed services. For example, someone teaching for free. Although not typically a significant source of support in higher education, contributed services meeting the criteria for recognition under FASB standards would be recognized as revenue by private institutions. And actually, it's not that common, but it does happen sometimes. I've heard of examples of someone famous going to a university and teaching the course there. They don't get paid for it. They're just doing it pro bono. And I remember also when I was teaching briefly at Hillsdale College, they had a rich oil executive from Tulsa who taught class twice a week in Michigan while he lived in Tulsa. He was wealthy enough that he paid for his flight every Tuesday morning to fly to Michigan, and then every Thursday afternoon to return to Tulsa, and then taught a class on Tuesdays and Thursdays. And was not paid for it. He was donating his services. Okay. Public colleges follow the enterprise format, while private college separately present restricted revenues. So what I wanted to do for this was to enlarge it as much as possible, because that's really teeny tiny print. So on the next slide here, I've taken the Mountain State College of Design and filled it up to as much as I could for the whole page. So if this is too small for you to see in your computer, then you might be able to go to the file that's on Canvas, open it up, and then enlarge it as much as possible. So since it says at the top public institution, it's a giveaway since it says state college. And so we have operating revenues, student tuition and fees, less student financial aid. So you remember what they called that in the lesson earlier on Monday? They called that discounting. So the net, then federal and state grants, auxiliary enterprise revenue. So that would be dining halls, dorms, bookstore, like that. Operating expenses, instruction, research, student services, academic support, institutional support, auxiliary enterprises. Operating loss, 5.6 million. Non-operating revenues, state appropriations. So they're not charging nearly enough tuition to cover their costs. So they get money from the state government, 4.5 million. They got Pell Grants from the federal government to pay for low-income tuition, 1.35 million. Contributions, donations, 80,000. Investment income, 32,000. Then paid interest. So net operating revenue. Other revenues, capital grants and gifts, and additions to permanent endowments. So their net position is shown at the end of the year. And so we had beginning of the year plus increase gives the end of the year. Questions or comments on that statement before we look at the next one for a private? Okay, so here is a private institution activity statement. And let me open up the share screen again. So we have operating revenues. And then in this category, they have net assets without donor restrictions. And then net assets with donor restrictions. So we had student tuition and fees, less student financial aid. Remember, they call that the discount. Federal and state grants, auxiliary enterprises. You get total revenue, the operating revenue, then program expenses, instruction, research, student services, academic support, auxiliary enterprises. Institutional support is a supporting expense. That's the administration and the fundraising arm of the institution, total expenses. So operating loss, 278,000. And contributions, unrestricted, 580,000. Restricted for capital additions, 425,000. And designated for permanent endowment, 1 million. Then the permanent endowment had investment income of $2,000, unrestricted investments, 32,000. And then capital addition, they completed some capital work here. And so they're taking the money out of the capital addition net assets and putting it into expenses. And so then we have change in net assets. And so this is the combined column for all of the university, or actually this is a seminary. So again, we have total change in net assets added to the beginning balance to give the net assets at the end of the year. Questions or comments on that? Okay, then we had here statement of net position. And again, these are really tiny print. So I took the slide they had and made each of them individually as large as possible. So here is the State College statement of net position. And remember, this would be their equivalent of a balance sheet. So they have current assets, cash, student accounts receivable, receivables from federal and state governments, non-current assets, endowment, capital assets, so that would be their physical plant, net of depreciation. Total assets, 2,974,000. Current liabilities, accounts payable, deferred revenue, bonds payable, current portion, non-current liability, bonds payable. And so then the net position is divided up into 3 categories. Invested in capital assets, restricted, and unrestricted. For the private seminary, current assets, non-current, current liabilities, non-current. Pretty much the same format except for the net assets. So they've got cash, student accounts receivable, receivable from federal and state governments. And note then that these would not be, these probably would be like Pell Grants and that sort of thing. Pledges receivable, which was not part of the government one. Endowment investments, land, buildings, and equipment, net of depreciation. Accounts payable, deferred revenue, bonds payable, current, not long-term bonds payable. And then net assets are divided into the category with donor restrictions and without donor restrictions. And I want to go back and take a look at something. Note in this table that we looked at before, it says the private not-for-profit have two categories. So when we got to this particular slide, right here, capital additions, I'm not sure why that's there because that's not the two categories that are listed. They might be trying to contrast that with the government, which has to have a restriction for capital. Okay, statement of cash flows. Let's stop the share a moment and see if you have questions about what we were looking at. GASB requires the direct method. FASB permits a choice between direct and indirect. Most organizations choose the indirect method. GASB format, the statement of cash flows has 4 sections instead of 3, and differences exist in the definition of each section. The result is that individual cash flows appear in different sections of the statement of cash flows depending on whether the college is following GASB or FASB guidelines. Under GASB guidelines, state appropriations and Pell Grants are reported as non-capital related financing activities. Interest expense is a financing activity. Investment income is an investing activity. Split interest agreements. Both public and private colleges encourage donors to consider giving to the institution their estate planning. This may include creating a trust agreement, but all the stuff they have here from here to the end is about people donating, especially in their wills, to a college or university. And I think that's mostly of interest to college fundraisers and wealthy donors. I'm going to skip this section, which is the remainder of the PowerPoint, and it will not be on your quiz for this chapter when I prepare it. So we have finished this particular one. So let's go back to the beginning slide here. This is chapter 11. We've got 2 more chapters that I'm going to cover. Let's stop the sharing here for the end of the semester. And those 2 PowerPoints are now both posted on your Canvas page under files. And so let's see, what was chapter 12. I've forgotten. Hospital. Okay. Hospital and healthcare accounting. And we really need to go over that. There are a lot of jobs in hospital accounting because it is one of the largest industries in America. And then we'll finish with chapter 14, which is federal government. And so that's my original plan for how much I thought we could cover this semester. And I think we're pretty well on track to be able to do that in the time that's remaining. So Friday is Good Friday. We'll have no class. And then Monday was supposed to be the vacation for Easter Monday. I think we can finish all the stuff on time if we stick to the original schedule and don't have class on Monday. So we will resume Zoom on Wednesday next week. So this should give you a chance to start taking the quizzes. There are 3 of them that are now posted on your Canvas page for chapters 6, 7, and 8. It takes me about 4 or 5 hours to prepare a quiz, so you're getting up there kind of slowly. So any questions or comments before we see each other again on Wednesday? All right, then, be careful. Follow the advice about how to stay healthy during this epidemic. And if you need help with anything, then you can email me. How are we doing with registration for fall? All right, so I will see you all on Wednesday next week. Take care.
Bye.